It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me, as always, the man himself, Doctor of Multifamily, the guy that everybody turns to when they need to have an answer, Mr. Michael Becker. Michael, how are you?
Paul, doing good today. How about yourself?
Doing great. This is kind of the year review of 2021, and I thought we would just kind of talk a little bit about what you're seeing out there, what operators like Michael Becker and the group over at SPI is seeing out there. Any words of wisdom or advice for maybe some new general partners, new limited partners? Is it still a good time to maybe still invest in multifamily? And this is general, just a conversation of your sentiment and what you're seeing out there. As you know, Michael Becker is an operator of multifamily properties. Him and his group over at SPI, they manage over and have owned over 10,000 apartment units. Michael's a former banker for one of the largest commercial real estate banks in the country, and then he went from being a loaner of money to an owner of real estate. So we really do count on Michael's opinion about what is going on in the multifamily space. Now, his portfolio is mainly in Texas, so it's a little bit slanted towards Texas, but he has his fingers on the pulse about what is going on in the world these days. So, Michael, end of the year review, what was your 2 cents for 2021?
Man, it was a hell of a year. It escalated quickly, seemingly, kind of started the year out, with everything kind of starting to reopen from the economic standpoint and kind of getting back to normal for the most part. And then in Texas specifically, we had the great freeze of February. And so that was a huge challenge. I mean, virtually every property in the entire state, some form or fashion, was affected by the freeze. So we had a bunch of these newer buildings. You have fire sprinklers, Paul. So you have the fire suppression systems all when they cut the power and you had negative degrees and we're not insulated to the same level as you would be if you're in, say, New York or the Midwest or something. These pipes froze and caused quite a bit of water damage. So trying to get a fire suppression system, they probably did 5 years of work in 4 or 5 months following up the freeze, Paul, and plumbers, et cetera. So that was a big challenge. But it felt like as soon as the ice kind of melted, the market got extremely white hot from investment sales and from an operation standpoint, both. I mean, I think I was looking at some recent trade outs here. I mean, we're still averaging upwards of 20% rent growth on the new leases. So kind of your new lease trade out. So old tenant moves in, you replace with a new tenant. We're kind of 10 to 11-ish% on renewals. So it's been one hell of a thing.
Is that pent up demand from last year or the year before where we maybe hadn't gotten that much of a annual increase on rents? Or is that just the way it's going to be for next year and the year before, year after that, and the year after that? I'm
not quite sure. Speculating, I think, certainly it's probably a little bit of everything, Paul. I think, it's important to point out too, the portfolio we own is, A to A minus, and we're not really doing a whole lot of value add. So this is kind of organic rent growth. I think if you're in the workforce housing, you saw on organic rent growth a much more muted number than that. So, I would probably cut these numbers in half as kind of the anecdotal part. And the little bit that we have is, it's probably 5% on renewals and 10% on new leases or 8 or 9 or something like that. And then you can get further lift if you do spend money and do the value add. So I think that's important distinction to point out. That's just organic rent growth, which is unbelievable. But yeah, I think, Paul, part of it was, we had Greg Willett on this year and he talked about how, 2020, you didn't really have a big bump from the graduating college students. So those college students kind of stayed home. So then when they graduated in 21 and May, then you had kind of basically 2 years of graduating classes going in to the workforce and formations of households and renting apartments, et cetera. I think part of it's that. Part of it's the alternative of the single family homes. I mean, you see record pricing on single family homes, so it made it less affordable to buy a home. So it's kind of prolonging the renter class, which I think is partly to benefit the upper end of the housing stock, Paul, because those people that can afford a home will afford a little nicer apartment, generally speaking. So that's probably what's leading to some of the new supply getting absorbed so quickly. And I think, generally speaking, some of the delays and some of the deliveries probably limited a little bit of the supply. So I think it's some combination of all that. Plus, you're seeing real wage growth, and those people can actually afford to pay a little bit higher wages. And then we've seen just a ton of immigration in Texas, and the Sun Belt in general. And Texas is certainly kind of the center of the bullseye for a lot of that. So you're seeing a lot of people just relocate from the coast to higher cost markets into historically more affordable markets. So it's been some combination of all that.
We talked a little bit about materials. I mean, materials on value-added properties. Again, you guys don't do a lot of value-added properties anymore. The properties that you're buying are the properties that were built 3 years ago, last year, 5 years ago, 10 years ago. So they're fairly new, and you're probably just doing limited upgrades. How has the supply chain problems backup affected you guys?
Yeah, I think it certainly had some impact, and like you said, we're not doing as much, but I'm trying to find appliance packages is tough. Labor's been tough, so everything's just harder nowadays. So that certainly has been some level of an impact. I didn't quite finish my thought going back to what I was saying. We talked about the operations side, but then the investment sales side, Paul, has been absolutely on fire. Really, about March, I kind of noticed a big shift, and the amount of capital that was seeking to get into multifamily just really accelerated. I mean, this might sound crazy, but in Dallas-Fort Worth, the market that I played in, I mean, it's seemingly from the beginning of the year to as we wrap up, I mean, I think we've probably seen maybe 50, 60,000 a unit in pricing movements. So, so Dallas-Fort Worth, call it somewhere around 60,000 a unit, generically speaking, higher pricing, kind of that top end of the market. And then I think if you go into Austin, it's probably closer to like 80, maybe more, thousand a unit. And then we started going down in San Antonio. It's been a little bit more muted there, probably 30 to 40,000 a unit and price increases. I mean, these are just staggering numbers. I mean, we bought a good example is we bought a deal last year, closed in December of 2020, brand new construction deal. It's got it paid about 190,000 a unit. Just got it valued by a broker at 270,000 a unit, and we didn't really do anything. We needed a paint job. I mean, it's just been insatiable the amount of capital that's coming into the marketplace. So
At what period of time do you sell that and put the money into a beach house or an airplane and sit and retire?
Maybe someone else would do that. I don't know. I'm too cheap, I think. So we're not we're not gonna do that quite yet. But yeah, no, it's great. It's just absolutely insane. I mean, those words don't even make sense coming out of my mouth. How could something go from 190,000, 270,000 a door in a matter of 12 months? I mean, it's just absolutely crazy. And I don't know what stops it, because I think kind of going forward, I think we're still seeing healthy rent trade outs. I mean, we're still seeing double digits on renewal and pushing 20% on new leases. So, I mean, we see that kind of rental inflation, then I think we're going to continue to see prices go up for the kind of near to intermediate term. So, I mean, we're still bullish on it. It's going to be kind of hard to go back into the marketplace. Like, so we did 9 transactions last year, Paul, on the acquisition side. We recapped 1, bought 1 in Austin, 3 in Dallas-Fort Worth, and 4 in San Antonio. And the ones that kind of bought in Dallas-Fort Worth and Austin were kind of the front end of the year. We kind of bought San Antonio on the back end of the year. So I'm kind of coming in at, $60-something thousand a unit higher as a baseline than the last time we bought a deal up here. So I'm curious to see how my mentality is going to be. Just emotionally, can I pull the trigger on something like that? And I think the answer is yes. But that's going to be challenging for sure.
You can talk a little bit about buying 9 new apartment buildings, new being new to you, not being the age of the property, but maybe some of them were new. You'd have to talk a little bit about that. But one of the things that you talked about is recap. And then you guys did a recap. What does recap mean to somebody that's never been in apartment ownership or financing? What does that mean?
Yeah, we basically bought the deal from ourselves. So we swapped out one equity partner for another equity partner, which worked out well. We had a gentleman that we've done business with for several years, and we had a nice gain in it. And he was, we're trading up and unit count and value, et cetera. So we were able to find another partner to come in, and we agreed upon a price, and we basically just bought it from ourselves. And then we took those monies that we generated from the acquisition, and we did a 1031 into a larger property. So it worked out pretty well.
So you stayed in the deal, you kept your position in the deal, but you had so much equity that was in that transaction over the couple of years that you guys have owned the property that you found, another equity partner to come in and kind of, would you say, cash yourself out on the deal?
Basically, yeah. And then we put cash in the new transaction as well. I mean, I think our view here at SPI is we want to grow, and we finished the year about 7,500 units, and we want to finish next year around 10,000 units. And every time you sell a deal, you're going backwards, and you gotta work twice as hard to grow. So this was a good way to kind of maintain the unit count, get kind of future upside. We still believed in the asset and thought it had some more future upside, but it was a good opportunity to take some debt equity that, these equities, doubled up basically in the ownership period that we had it, and take that and then just go place that into a larger transaction and kind of grow on a larger base. And that made sense for our existing partner, and value made sense for our new partner. And so it just kind of worked out.
Now, everything is kind of relative to life these days. And so if you're a new multifamily owner, you're out searching for properties, trying to buy maybe your first one or trying to find inventory to buy your second or third one after you've had a success in the first one. And so, Michael, this period of time, tell me a little bit about what you're doing to find new properties out there, maybe just some of the marketing that you're out there that maybe can apply to new apartment buyers that are in this space. What could you say that are kind of parallel to where you're at right now that some newbies should be thinking about doing too?
We do a little bit of everything, Paul. I mean, we try to look at every deal, on market, off market. We try to at least look at everything in the world that we want to play in. So try to just track everything on market, off market. So I'm constantly having conversations with brokers in town and just constantly kind of seeing what they have. Well, right now we're kind of wrapping the year up, going into 22, and the big push usually comes in mid to late January when there's a big apartment conference, NMHC. So that's where most of the bigger owners and all the brokers pretty much across the country all go to. This year's in Orlando.
Are you going to go to that?
Yep, go to it every year. So that's a good place to go, and then all the brokers are there. There's parties, and so right now a bunch of owners are getting brokers' opinions of values of BOVs to decide, hey, what's my asset worth? Is it a good time to sell it? It's a logical time to kind of sell. So this is a time where the brokers are pretty busy talking to a bunch of ownership groups, and maybe will sell, maybe won't sell. So we're trying to see what's been said already. Is there anything that will look at an early offer? Is there anything the broker that might not win the listing that maybe can slam an offer in? So those are some of the things. Those are the types of conversations I'm having like in real time as we record this. Those are the things I'm doing right now. We bought a deal last year. The last deal we just closed on last week as we record it was a deal that was fully marketed, went through the marketing process. They picked a buyer couldn't close. And then I was there, caught a boomerang around when the first guy fell out. Timing didn't work out for me at the time. But, a month later, I was freed up and was able to take the deal down. So that was another way that we got a deal kind of like post-marketed, I guess I would call it that way, Paul. And then, when the deal right before that,
they call that the previous buyer shit the bed, so to speak,
basically,
and couldn't close.
Then there was this other deal that was on the market that we thought the price was going to really, really run. We had previously purchased a couple assets from the same seller a few years prior, so we had a good relationship with them. So we came in hard and preempted the process and got the deal awarded before it went all the way through, about a week into the marketing. That's kind of rare to get that done, but we were able to accomplish that because we had a prior transaction with them. So, I mean, it's as I've said repeatedly, it's a completely unfair business. So you need to kind of figure out what the situation. Every deal is a little bit different. As I think you could say, every transaction is like a fingerprint. It's a little bit different. So you need to kind of customize the right approach for whatever the situation is. And so we're just always trying to look for that little angle that we might have on the rest of the marketplace that we can try to take to our advantage and push the deal our way. So whether that's going early, whether it's waiting it out, whether that's trying to get something off market, a lot of it's just about being consistent in front of these brokers on a regular basis and showing up to things like NMHC or going to the brokers' happy hours or whatever it is.
You guys are so good at finding and acquiring properties, but for some of the new people that are trying to raise capital, name some of the tricks, but some of the things that you guys have done to instill confidence to the people that are wanting to invest with you. One of the things I think, throw this out there, maybe that this will trigger some things. You guys had a holiday party back in November, and you had a couple hundred people that showed up for that. Tell me a little bit about, is that a good idea for newbies, maybe that are have their first deal, maybe even have a Zoom holiday party if the folks are, your investors are from all over the place? Or tell us a little bit about some of the things that you guys do that you think would be beneficial to people that are just getting into the business to try to attract and raise money.
Yeah, we threw a holiday party in November. It was actually Veterans Day, so we did it a little bit early because this time of year, everyone's so busy with stuff. So we did it a little bit earlier this year. Had a couple hundred of our investors come out, mainly people in Texas. We didn't have too many people flying from out of state, but we did it here in Dallas at a local restaurant. Had a band and food, and it's kind of it's pretty low key, and that was a good way to get to talk to nearly 200 people that we either do business with, either as investors or vendors or whatever. We brought a bunch of the brokers in town came to it too, Paul. So that was also good. And then I think that kind of also instills a lot of confidence in the brokerage community that I'm a legit group and we have real people that do business with us. And it's not telling them how credible I am, but it's kind of showing them how credible we are. And I think that was also helpful. So yeah, something like that, or you can just do like a simple little happy hour at the back of your local Mexican restaurant or whatever. You do something like that. I think it has similar effect. And I think people do business with people they know, like, and trust. And the more you can do things like that, the better it is. I mean, I'm kind of kicking around the idea of doing like maybe a little bit smaller events where we get some of our higher end investors and see if they can like refer a friend, for example. That'd be something else that we're kind of working on as well, Paul. Just always trying to get out and expand and, ask for referrals and be consistent in your financial reporting. I mean, that's one thing that we've done. So as soon as you get a deal done, make sure you report and be very consistent and regular in your communication and be transparent and follow through. Those things matter quite a bit. I think that's probably the best thing that we do to get repeat and referrals from our investors.
Talk a little bit about financing, my favorite subject these days and for the last 36 years. But tell me a little bit about financing. Did you guys do a lot of Fannie Mae, Freddie Mac, bridge loans, FHA, CMBS? Tell me a little bit about where you guys came at with your business model.
Yeah, we used to only do Fannie Mae almost exclusively, and we haven't done a Fannie Mae loan in 3-4 years probably. And we actually signed up our first one in probably 3 years, which is great. It's they finally got more competitive with their floating rate SARM product, structured ARM product. So we're refinancing a deal right now.
What's the benefit of that program for you guys? What is that, a 10-year fixed rate? It's an adjustable.
Yeah, so we're done eating yield maintenance and defeasance, Paul. So the large prepays that come with the long-term fixed rate stuff, we're kind of out on. So this allows you, flexible exit, and it's a 10-year loan. I think 5-year IO is the amount of IO period we have, and it's going to be, floating rate over. So that's I can't remember what the spread was, but you kind of mid twos over SOFR. So it'll be kind of mid twos to start, and then we'll see how quick and aggressive the Fed actually hikes rates in 22. It seems like they're going to get at least a couple of them done from what they're talking about. So that's but it allows us some flexibility on the exit. So that's what we've been doing, a lot of Freddie 10-year floaters, very similar product, 10-year term, 5-year IO, flexible floating rate over SOFR. So that's been kind of the loan of the last, say, 3 or 4 years for us. We've been doing quite a bit of that. And then we did 3 bridge loans with a bank and 1 with a debt fund. And I wanted to shoot myself after doing the debt fund one. So I committed to never do another debt fund loan again. It was expensive and cumbersome and made us jump through 1,000 different legal hoops. So that wasn't very exciting for me. And we ended up being like in the 60s on our leverage. So we didn't even push the leverage. So it seemed kind of ridiculous that we had to do all the stuff they made us do. So then we did 3 loans with a regional bank, signed a top 15%, I think, Paul, with some recourse, and got those real cheap. So I think those are kind of in the mid 1 over LIBOR. So those are really inexpensive loans, but they kind of had a short maturity, and you had to sign the top 15% loan and a personal guarantee. So that's kind of how they got them so cheap. For us, if we're putting 30 or maybe more % down and get a good quality asset, the risk profile seems like that's worth signing a handful of those loans on recourse.
Yeah, you just don't want to have too many of the contingent liabilities on your personal balance sheet that you've signed on behalf of a partnership that they're putting a big tattoo or a big bullseye on you that in case this deal goes down. But I think Mike is correct that if you have the right leverage, you're not up at 75 or 80% and you're down to 60 or 65%, then they have to burn through all that equity just to knock on your door to if there's a problem in the future. So we certainly do like that. But those type of loans are not really available for brand new people. As Michael says, it's an unfair business in life. It's definitely unfair when you are just starting out that you're not going to really have those type of opportunities. There's different ways of structuring those deals, and talk with your old capital financing person about what other options that there are out there. Going forward, Michael, what I know we're on a short time frame here. What's 2022 look like for you guys? What does it look like for the average investor out there? Is it still a good time to jump in the pool?
Yeah, I think so. I guess time will tell, but we're going to still be active, and we're hoping to do more in 22 than we did in 21. So I think we did 500 I tallied it up like 520 million in transaction volume, either on most of that on acquisition, and then we sold a couple deals too. So it was a pretty good year for us. Hopefully we'll do more next year. We are in 3 of the 4 majors in Texas, so we're going to start exploring a 4th market. We don't plan on going to Houston, so we'll continue to be active in the 3 markets that we participate in, and potentially add a new market. We're trying to figure that out now. Maybe we go out of state for the first time as we look to kind of get more opportunities, more pitches to look at, I guess, Paul. But yeah, still bullish. I think obviously, if the interest rates really run, that could have some level of impact on us. So kind of looking at that, major tax reform would have some level of impact on us. It seems like as of this week as we recorded, it doesn't seem like that's going to be likely since the Build Back Better got shot in the head here recently. So I don't think that's quite as risky as we might have thought a few months ago. So I think those are kind of your two biggest risks. I'm personally in the camp that I think the Fed's in a debt trap and they can't really make rates run because maybe add 200 basis points to the interest rate and you have 30 trillion or whatever in national debt. That'll eat up quite a bit of money here real quick. So make it really hard for them to let rates really run. So I got a feeling that we're in a lower inflation or lower interest rate environment for a while, and they'll just have to let inflation run a little bit hot. Seems like obviously there's inflation here, and we're certainly seeing that in many aspects, like rents going up and labor and materials and all that good stuff. So I think it should be supportive for people that own hard assets that have short-term leases like multifamily apartments do, that you can kind of get your debt kind of set. You should see your rents go up pretty quick. You should be able to take advantage of it because you have 8% on average of your leases come up every month, so you can reset these rents in a pretty short order. It's not like a 5-year lease like you have like an office building or something like that. So I think all in all, it should be pretty favorable if you're in some of the on markets, mainly like the Sun Belt seems to be where people want to be. So we're very bullish about that. I think the headwinds really come from where they have been, which is labor, taxes, insurance. Those are kind of where your inflationary pressures are going to work against you. So hopefully the rents can go at a quicker rate than my taxes do.
Sounds good. If you want to get more information about what SPI does in your group, what's the best way of getting a hold of you guys?
Yeah, really the best way is just simply go to our company's website, which we recently revamped it a few months ago. So it's up to date and a lot better than it used to be, which is www.spiadvisor.com. There's a bunch of information on there, contact form you can fill out to get into our investor database and learn a little bit more about what we do.
I love it. All right. That was the good Dr. Michael Becker about, and again, he's not a doctor for anybody.
I did go to college for 8 years, though. I'm not a doctor.
That's right. He was in college for 8 years, but he's not a doctor yet. But great insight about what's going on in multifamily, especially in the universe of Texas and apartments and about things that are going on in commercial real estate. So great information, Michael. We certainly do appreciate it. Again, I'm Paul Peebles. Have a great day.